Good afternoon, everyone, and thank you very much for having me. I knew that I was going to go before lunch, so I had to have a title that was really going to get your attention. And what do rhinos have to do with economics? But we have moved out of a space where we predominantly faced the unknown unknowns, things that might have a small chance of occurring, very, very high probability and severity of actually affecting the global economy. But we've now morphed into a world where we actually know what those risks are. But we're not yet really capable of dealing with them in an efficient way to actually save global economic activity. And the world that we've morphed into really is governed by a new set of economic rules and economic power. Now, when we came out of the period of the late 80s, it was the fall of the Berlin Wall, the end of the Cold War period. Governments effectively came around a table to say that we're going to lower arms, intentionally so we could usher in a period of stability, predictability, peace, and global coordination. And we now know that period to be called the so-called peace dividend in society. However, that peace dividend prevailed for about 30 years. About 10 years ago, we started to see the inkling of governments starting to spend a bit more on military and defense. And we've seen it in far more earnest in the last 5 years, to the extent that we now have a world economy that this year is going to spend up to $3 trillion on military and defense systems. The US makes up a third of that alone. Now, it's a staggering amount of money. It's also money that governments don't really have to spend, because it does mean that it's now going to be reoriented away from socio-economic spending and away from infrastructure just to arm up economies as we see geopolitical risk take the forefront of investors' minds once again, and economic policies just taking the direction of what is happening on the geopolitical stage. So we've seen that the geopolitical risk index in the past has spiked on occasion, like 9/11 or the Iraqi war. But in the last 5 years since COVID, we've seen that the average geopolitical risk index has averaged at a higher level than what we've seen in the past. We're no longer living in that globally coordinated world where multilateral institutions govern quite strongly. Think about the backlash that has come forward now for institutions like the World Trade Organization or the United Nations, because they're not actively encouraging emerging market participants in those dialogues. And so, with this increase in geopolitical uncertainty, comes the revival of unpredictability, high volatility, and it's quite a difficult market for businesses to operate in. So that's the downside risk to global economic activity over the next while. But what is the potential upside? The potential upside that we see is potentially coming through from the productivity-related gains from artificial intelligence and technology advances. But there's some big questions to be asked. We came out of the dot-com bubble at the end of the 1990s, going into the early 2000s. And some of the things that we are seeing now are starting to ratchet up memories of what we experienced in that period. So is it that the AI bubble is going to pop, or is it merely going to fizzle out? Or are we actually going to see revenues and earnings estimates actually keeping pace with this inordinate amount of money that has been spent on capital expenditure for the big hyperscalers in the world? So there's a couple of flags that we need to watch out for, or a few questions that we need to answer. The first is, has productivity actually picked up? So I think where we can all broadly agree is that AI is being adopted at a higher rate than what we've seen in the past. It's been across different sectors, it's been across different geographies, but has productivity actually improved? This chart shows you, it's a very messy chart of spaghetti lines, but that's productivity. It's very difficult to calculate from the economy. It's almost like your residual factor. In year-on-year terms, the amount of productivity gains that we got out of the US has been bang in line with the average that we've had since the 1940s. So with all the CapEx spend that has come about, with all the attention on AI and technology, we haven't actually seen that translating into real economic progress on the productivity side. Now, Robert Solow, the father of technology, once said, "You can see the computer age everywhere, excepting in the productivity statistics." So we may again be in that world where productivity is lagging. We haven't quite seen earnings of these major AI-related companies quite yet keeping pace with the amount of capital expenditure that has come through. The second kind of flag to watch is that AI and technology has a very high environmental price tag. It uses a lot of energy and it uses a lot of water. Are we going to have enough to sustain the growth in the supply chains for the big AI boom that we are currently seeing? So if you had to take ChatGPT Model 4, you use 400 million users, and they have 5 prompts a day on the system. It's been calculated that that would use the same amount of energy that Times Square, all of their billboards, would use in 20 years. On the right-hand side, very intensive on the water side as well. In 1 month, you would use the same amount of water as you would have to give every single person on the planet, children included, 2 glasses. So this tells us that we are starting to run up against resource constraints. We've seen the transmission grid in America coming under severe pressure where they just don't have enough in certain states to support the data center rollout. Now, in the past, the chart on the left shows you that electricity demand actually came off in the last couple of decades because we can make as much GDP using fewer units of electricity. We've become more efficient. But in the next 5 years, that last bar on the chart, this is what electricity demand growth is going to look like in the next 5 years up until 2030. Why is it picking up again? The chart on the right shows you that half of this demand is going to go towards data center usage. So at some point, electricity prices are going to be a big problem in America for US citizens. These are the types of flags we need to watch out for to answer the question of whether AI is indeed a bubble. Are we actually going to see those productivity-related gains coming through? Are we actually going to see earnings starting to improve on the amount of money that has been spent on CapEx? Another key theme that I want to touch on, and this is really going back into that period of stability of that 30-year period after the Cold War. That period was one in which countries actually effectively lowered borders. This is where the birth of globalization came from. And the idea was to have the easy movement of people, technology, goods, capital to go across borders. But we've now entered a period in time where countries are effectively building up walls around their economies once again. Citizens have become very disgruntled in that globalization delivered for countries overall, but it did not deliver even gains. And that means that there have been a big part of the global population that have just been left behind. These disgruntled citizens are now voting out political incumbents, looking for the far left or the far right to solve their problems of the high cost of living. In this, countries are focusing on what we call economic nationalism. Me first, and then we sort out global ills later. And this, I think, is going to have severe consequences for how socioeconomic policies are set in the global environment. One of the areas in which we can see these walls being built up again is in America, where we've had new tariffs being introduced. Now, of course, the courts have come back and have said that some of these tariffs that have come through are actually being ruled as illegal, such as the reciprocal tariffs and the Section 122. But I do think that protectionist policies are here to stay. It's not just the Republicans that believe in economic nationalism. We're seeing it in parts of South America. We're seeing it in parts of Europe. We're even seeing it in parts of Asia. And so I think that tariffs are going to become a key political weapon going forward. The tariff rate that we're currently experiencing in the world economy at an effective 10% is much higher than the 3% that we had before Trump was in his new term 2 of his presidency. It's also a lot higher than what we had in the last couple of decades. The last time that we saw tariffs this high, we were in the 1930s. We can't have an economic presentation today without talking about what is happening in the Strait of Hormuz and Iran. Now, Iran is a very small contributor of global GDP. Why is it affecting the world economy so much? because of its presence around the Strait of Hormuz, which is a key channel for things like crude oil, liquefied natural gas, helium, even polymers. Some of the car manufacturers around the world are now threatening to put up the price of cars because of the plastic components that are utilized in there. The Iranian conflict has also become quite a big US political risk story. In April, which was about 1 month into the war, 91% of the Democrats said that they believe that the war was because of Donald Trump, and the price of gasoline has picked up because of his incursion into Iran. Only 9% of Republicans believe that, as you can see on the chart. The most recent data that came out from the Financial Times more recently show that more than a third of Republicans are now blaming Donald Trump for inflation. This spells trouble for his popularity as he goes into the US midterm elections this year, with the markets now penciling in the outcome of a divided Congress. That means that Democrats could be in control of one house of Congress and Republicans in control of another. Now, what typically happens in a divided Congress is that you often have a lot of gridlock of policies. They may not be able to effectively roll back everything that the Republicans have brought in, but you're essentially not going to get any big reversal coming through either. As a result, you've seen that his popularity rating in the last while, the first term is on the left, second term on the right, you can see that this war of choice was far easier to get into than to get out of, and it is costing him politically. It has also become quite a big inflation story. The International Monetary Fund warns that in the most severe scenario, where oil prices stay at around $150 per barrel or more for a period of about 6 months or longer, would imply a very severe dislocation in the supply of oil. We would also have much tighter financial conditions because central banks would have to hike interest rates to curb inflation in that kind of world. And in that environment, inflation on average for the global economy would be as high as 6% for this year and even higher at 7% for next year as second round inflationary impacts come through as wages also adjust higher. This is a very difficult environment for monetary policy makers, not like that 30-year period where it was quite easy to discern where the turning points for inflation and growth were. It has also become quite a big growth story because as inflation goes up, consumers have less and less money in their pocket to spend at the end of every month. And that, of course, dents economic growth, given that the consumer is a good 2/3 of GDP outcomes in most economies. The IMF, again, in their scenarios, point to a severe scenario where growth could potentially be as weak as 2% this year and even 2% next year. Now, at 2% for the world as a whole, it does imply that there are some economies that are, in fact, in contraction. It's not difficult to see which ones those would be. We know that the likes of the UK and other parts of Europe are very dependent on oil coming out of the Strait of Hormuz. In turn, it has also become an inflation story. This is what economists refer to as a stagflation problem, when growth is below what it should be and inflation is higher than what it should be. This is a very difficult environment for monetary policy makers because if it was just an inflation problem, you would hike interest rates. But when you hike interest rates, everyone with a home loan or car loan is going to feel the pain of higher interest rates as well. And so you can do damage to the economy in the same light. Now, at the start of the year, it was quite an easy story for central bankers. You can probably cut interest rates because inflation continues to fall. A few months later, rolling into post 100 days of the Iranian conflict, and now markets are actually anticipating that monetary policy rates across the globe go upward. So tighter financial conditions around the world, more expensive borrowing, more difficult to extend capital expenditure in an environment like this. We spoke a little bit about the AI bubble. We've seen corporate debt issuance at a record high in 2025. A lot of that debt is coming due in the next while. If interest rates are going up, you are financing that debt at a higher level. There's going to be a lot of pressure on some of these hyperscaler firms in the near future. Governments are also in a position where they can't actually bail out economies. Debt to GDP is sitting at highs in most economies around the world. And so this time around, governments couldn't give the same support to consumers like they did in 2022 when Russia invaded Ukraine. As I mentioned earlier, governments are also spending a lot on defense, but this is coming at the cost of citizens around the world. South Africa has also felt the impact of the Iranian shock, which has not stayed localized. and that has been predominantly through oil. Now, Nigeria and Saudi and Angola make up the bulk of our oil imports on the crude side, but the problem in South Africa is that we've closed down a lot of our refining capacity. A lot of it is mothballed. So a lot of the fuel and diesel that we actually get into the country has to come from areas like in India or in Italy. But what's not on this chart is where the derivative of that oil actually comes from. So it all eventually comes through from the Middle East itself. And that is where our reliance comes from. Fortunately for us, fertilizer not so much of an issue, but fertilizer costs have also gone up because of the Strait of Hormuz and what passes through there. So for many countries in Africa, higher fertilizer costs are going to bear down very negatively on inflation and on growth outcomes. We have felt the shock through higher fuel prices coming through in the form of inflation. The South African Reserve Bank says that if we are in that severe scenario, we might actually have inflation at around 5% for next year, in which case monetary policy would have to react quite strongly, and we'd probably see more than just one hike coming through. This, of course, all depends on the duration of the war from here. Fortunately for us, South Africa is not standing still. We have made some improvements, and I do think, bar the war, in the medium term, we can still achieve a 2% growth handle in South Africa. The first sign of this is that we've done a lot on reforms in the energy and the logistics space. On the left-hand side, a lot of interest in private sector renewables. On the right-hand side, the problem of railway capacity is becoming less so going forward. We're starting to see railway volumes picking up. We've seen some private sector participation here as well. We've also seen marked improvements on our fiscal side. And so we've seen that government that used to spend a lot on the government wage bill and used to spend a lot on social grants, we're seeing that the year-on-year growth rate of these big ticket expenditure items are now starting to come in. And we've been rewarded for this. So we've seen the likes of S&P rating agency last year, Moody's earlier on this year, and Fitch on Friday last week, actually upgrading South Africa's sovereign rating. There is one last risk that I'll leave you with that's coming up later on this year in November, and that is the local government elections. Now, in South Africa, local government elections used to be quite a boring event, but I think everybody's eyes are on the local government elections this year because there's a lot at play. We've seen that the African National Congress, on the back of things like the Maklanga Commission, the Phala renewed investigations, continued corruption cases, have actually lost support in their key constituencies, being black voters, rural voters, and township voters. This is going to lead to a highly contested result on the metros later on this year, insofar as that the DA is now polling stronger than the ANC in places like Ekurhuleni and Tshwane. This is something I think we need to watch out for in the South African context, because it could potentially lead to the ANC trying to get back some of those lost votes by leaning towards leftist policies, which could derail the good economic reforms that we are seeing from here. So thank you very much for your time. I hope I gave you some food for thought on the economic side. I know it's a little bit of a different presentation from your set of presentations today. And thank you so much.